Welcome to the Explainer. Today, we are diving deep into the 2021 white paper for Uniswap v3. And let me tell you, this wasn't just an update. It was a protocol that completely rewrote the rules for decentralized finance. Okay, so to really get the genius behind v3, you've got to understand the problem it was built to solve. And this slide, it nails it. With Uniswap v2, your money was basically working everywhere. It was spread super thin across all possible prices, from zero all the way to infinity. But v3 came along with this just revolutionary idea. What if you could decide exactly where your money goes to work? Not everywhere, but where it matters. So here's how we're going to break this all down today. First up, the problem with infinity. Then we'll get into the v3 revolution itself, concentrated liquidity. After that, we'll look at the new rules, new tools it created, how they built a smarter oracle, and finally, what it all means for the dawn of DeFi 2.0. Let's get started. All right, Section 1, the problem with infinity. Or, the massive capital inefficiency of Uniswap v2. See, back in the day with v1 and v2, liquidity was, it was spread thin, like incredibly thin, across this massive, infinite price curve. Here's the deal. In v2, your liquidity was distributed uniformly from zero to infinity. That means most of the capital in any given pool was just sitting there, totally unused. I love this analogy. Imagine you're a shopkeeper, right? But you're forced to stock every single item you can possibly imagine, even though you know that 99% of your customers are only going to buy the same few things. All that other inventory, that's your capital, and it's just sitting on the shelf collecting dust. That was the exact problem with v2. So much money was just idle. And hey, don't just take my word for it. This is a direct quote from the v3 white paper. The creators themselves pointed this out, saying that constant function market makers, or CFMMs, were super capital inefficient. They knew that only a tiny fraction of the assets in a pool were actually available at any given price. All that other money, it was just waiting around, not earning a single cent in fees for the people who put it there. Which brings us to Section 2, the big revolution. The elegant solution to this whole mess. It's called concentrated liquidity, and it's all about putting every single dollar to work. So what is concentrated liquidity? It's the ability for liquidity providers, we call them LPs, to put their capital inside a specific price range instead of just spreading it out everywhere. Going back to our shopkeeper, it's like they can finally say, you know what? I'm only going to stock the stuff people actually buy. As an LP, you can now decide, I think Ether's going to trade between, say, $1,500 and $2,000. You put your money just in that range, and suddenly your capital is way, way more effective. And actually doing it is pretty straightforward. You just follow these steps. You pick a low price, you pick a high price, and boom, you provide your liquidity within that little window. That's your position. It's the exact spot on the price curve where your capital is going to be active and start earning you those trading fees. But here's the catch, and it's a big one. If the market price moves outside the range you picked, your position goes inactive. It stops earning fees until the price comes back. This creates this whole new powerful dynamic. You're now incentivized to be an active manager of your money. You have to pay attention and concentrate your capital where you think the action is going to be. Okay, so now we're in Section 3. This whole new world of active liquidity needed some new rules and new tools to go with it. We're talking flexible fees and totally unique positions. One of the first big changes was getting away from v2's one-size-fits-all fee. Remember that? It was always 0.30%. v3 threw that out the window and brought in multiple fee tiers. And this just makes so much sense, right? For a pair of stablecoins that barely move, you can have a super low fee, like 0.05%, which encourages tons of trading. But for a really volatile pair, you can have a higher fee, like 1%, to make it worth the risk for the LPs. Now, all this customizability, choosing your own range, your own fee tier, had a really interesting side effect. It completely changed how your liquidity is represented. In v2, you got a fungible LP token. Think of it like a dollar bill. They're all the same. But in v3, your position is unique. It's got its own specific boundaries. So it's not a dollar bill anymore. It's more like a deed to a piece of land. It's totally non-fungible. And you know what we call a unique, non-fungible digital item? An NFT. That's right. In v3, your LP position is literally an NFT. And because of this, fees work differently too. They aren't automatically reinvested back into your position anymore. Instead, they're collected separately, which actually gives you, the LP, way more direct control over your earnings. All right, let's jump into section 4, building a smarter oracle. Because V3 wasn't just about making things better for traders and LPs. It also delivered a massive upgrade to its price oracle, which is like the data backbone for all of DeFi. So let's look at the upgrades. Compared to V2, the V3 oracle is just better in every way. For data storage, V2 needed external help to track things. V3, it stores recent history right on the blockchain. Huge convenience boost. For the price average, it switched to a geometric mean, which is way more robust and harder to manipulate. And it didn't just upgrade the price oracle, it added a brand new oracle for liquidity too. Now, you might be thinking, okay, Oracle upgrades, whatever. But here's why this matters so much. This new on-chain Oracle means that other DeFi projects can get super reliable price data without having to build their own crazy complex systems. It makes building on top of Uniswap way safer and way, way easier. It's a foundational upgrade that strengthens the entire DeFi ecosystem. Okay, section 5, the dawn of DeFi 2.0. So, what does all of this add up to? What's the impact of this hyper-efficiency? Well, let me just say, the features in Uniswap v3 weren't just some small update. They created a massive paradigm shift. Let's just run through the key takeaways. First, capital efficiency. LPs can earn way more fees with less capital. Second, better prices for traders, because there's deeper liquidity right where people are actually trading. Third, flexibility. You've got custom ranges and custom fees for all kinds of different assets. Fourth, empowerment for LPs. And finally, stronger infrastructure. It's a more efficient, flexible, and powerful market for absolutely everyone involved. Look, Uniswap v3 wasn't just another update. It was a glimpse into the future. A future where digital markets are just smarter, where capital isn't just thrown around, but it's deployed with surgical precision. And that really leaves us with this one big question to chew on. What happens when every single dollar in a market becomes this efficient?